Hey, I hope you're all doing well out there. This is your November market review. So for those of you that have not watched these videos before, the reason that I put this video together each month is for my clients to give them the straightforward information about what's going on in the stock market, the economy, and ultimately how that affects their investments that I manage for them. So this past month, we had one of the best months in the last few years. The stock market, the S&P 500, was up close to 9% for the month, which is a phenomenal return after a drop-off we had from August through really about mid-October timeframe when the market kind of dropped to the low, at least on a short-term basis over the last handful of months. So it's great to see that the stock market's rebounded back higher. A big reason because of that is because interest rates on longer-term bonds, the rates on those started actually going down. So this was a good sign for investors, or investors in the stock market at least, because the longer dated bonds, if they're making higher interest rates on it, it's less attractive to invest in stocks if you can get a guaranteed higher rate of return on a bond versus taking risk by investing in stocks. So a little bit of a reprieve there in the bond market that helped out stocks. But overall, another big reason that stocks moved higher was because of earnings reports coming out where companies were reporting better than expected earnings again, which is a great sign for those individual stocks, but then the market as a whole as well. So those were some really good things heading into the end of the year here. As of today, which is December the 1st when I'm shooting this, the stock market was up about 20% for the year, which is phenomenal. A couple of things I'll go through here. We'll talk a little bit more specific about portfolios with the clients that I work with that have IRAs with me. If you're more conservative to moderately aggressive investor with me, I have some specific stuff I'm going to talk with you about in here. And that'll go into the first chart that I have actually. So the first chart here that I have is a chart that shows the buffered fund that I use for more conservative investors in IRA portfolios. For a number of you out there, if you're a more conservative investor that has money in a taxable account, that's an account that I may refer to as the middle bucket. That's for money that it's not retirement money, but it's also not money you want to leave sitting in your short-term savings, which is why I refer to it as that middle bucket. I use a lot of these buffers in middle buckets because of the downside protection that they give a investor by using this type of a strategy. So this is a picture of the risk reward and the fluctuation of the actual fund itself versus the S&P 500 ETF SPY. And the reason that I pull this up is because if you have an IRA with me and you're a little bit more of a conservative to moderate investor, you are almost guaranteed I have money in this fund for you. So, and the reason that I do that is this is a bond replacement. So bonds have done terrible over the last 3 years. And one of the ways that I've been able to help my clients that are conservatively investing is by using these buffered strategies that hedge a market drop if stocks were to really drop off, but they allow you to participate on the upside as stocks move higher, just like is what happened here this year. So this chart showing in the darker blue the price movement of the actual fund, and the lighter blue is the price movement of the S&P 500. Inside of this fund are call and put options that are bought and sold to create the buffers and then ultimately create the cap on the fund itself. This fund resets every 12 months, so it's actually coming up at the end of December where it will reset with a new 15% buffer, and then there'll be a new cap, likely lower than that 18.8%, but the new cap will give more upside potential for that following year then. So the reason I bring this up is because of one of the things that I've been looking at where while the market's up 20%, we've gone through, within the last couple of days went through that upside cap of 18.84%. The fund itself, it's showing here, it's up about 16%. It's up about, almost close to another percent higher than that. So there's really not a lot left remaining on the actual upside of the fund itself. So what I'm likely to do is I'm likely over the next week or so to roll this to the December buffer, which has just reset here in the very beginning of the month with a new upside cap. The cap on it's only about 14.5%, but then the buffer has then been reset where the buffer is at 15%. And the reason I do this is twofold. Is number one, it locks in that gain that we have of that 16, 17% within the fund, even though we're leaving that extra 1-2% on the table. What we're doing is we're locking in that gain, and then what I'll end up doing with that is then putting that in that December buffer, where now if the market really drops off over the next 12 months, what now is happening is that the buffer has eaten up that downside risk for that first 15%. So we're locking in those initial gains that we have over the last 12 months here, or 11 months actually, of 16%, while then resetting that downside protection. So I thought that was a chart. I typically don't go through the fund specific stuff, but it's a fund that a lot of you as my clients out there hold. If you're somebody that doesn't work with me and you've never heard of these, probably we should have a conversation. So, but it's definitely a great tool to use within portfolios because it allows us to make a lot more money than just sticking money in bonds, but it also offers us the protection of hedging a drop if the market were to drop. So great scenario for a bond replacement for sure. So next chart that I have here is showing the money market, the total money market assets out there as of the end of November. This is going back over just the last couple years where the money market funds, these are basically money markets are just very short-term bonds that are funds that hold a lot of very short-term bonds where they move directly in line with where interest rates are at, which is why they're the money market funds generally are right now around like 5%, give or take, because they'll track roughly what short-term treasury bonds do. But they're liquid, you can get at it whenever you need to. This is a place that a lot of people park money as a cash alternative instead of leaving it sit in cash where it makes absolutely nothing. Money markets are a great tool where you can leave that money in there. If you need it right away, you can get at the money right away within just a few business days, but it is at least earning some interest on it. The reason I bring this chart up because I thought that this was a good chart to talk about where the market's at and where investors are at, is that there's about $5.5–6 trillion sitting in money markets, which has gone up a little over $1 trillion over just the last year and a half, 2 years since the beginning of 2022. The reason I think that this is important is and then it's gone up that much is because interest rates have gone up, but it also is a really good sign because this is a cash equivalent. So there's a lot of money sitting on the sidelines that will help propel stocks higher if the market were to drop off, because this money is just sitting there while it's making 5.5%. It would also, in a lot of cases, while investors may just want to make that 5.5%, a lot of investors just park their money in money markets because they don't see any stocks that they're looking to buy at the moment. If there was a drop off in stocks, my bet is that this would dramatically drop off, which is actually kind of what happened here just in October. You can see that little tick down here where September, October, money market funds dropped off, and then as markets increased here over this past month, they've gone back up. So just kind of a sign of where money is flowing to and where investors as a whole are looking to put their money. So I thought that was an interesting chart to talk about. That's a little bit more like of an internal thing that I look at, but also an optimistic sign of not just where stocks are at right now, because we're about 5% from an all-time high right now. So we're not at new all-time highs, but close and knocking on the door. But this is a good sign that there's a lot more potential room for stocks to move higher because there's all this cash sitting on the sideline. So, okay, next chart I have that we're looking at here is a chart of the U.S. existing home price 12-month change. So the most recent number that came out was the number in October. It was up 3.4% over the last 12 months. So this is going back from the change from October of 2022 through October of 2023. U.S. home prices have gone up 3.4% is what this is showing. So I bring this chart up because, and this may not be specific towards, if you're one of my clients out there that already owns a home and you're not looking to buy another home and you're not looking to sell your home, probably isn't for you, but you probably know somebody where this is important to them. Because if you're someone out there that is looking to buy a home and you've been sitting around over the last handful of years waiting for the opportunity to buy a home, whether you be just saving money or, the timing isn't right, whatever the situation looks like, I've gotten so many people, and I bring this chart up because, not only, obviously I'm not a realtor, but as a certified financial planner, what I do is I help my clients with making good financial choices. And one of the biggest choices that people are going to make is buying a home. What I've seen and heard over the last handful of years is people waiting for that drop to happen within real estate prices, thinking that, well, of course prices are going to drop off because they've gone up so much. They have to come back down. And the reality of it is that they don't. And this chart kind of depicts, not just the price movement that we had from 2020 through 2022 with that huge move higher, just year over year change, but it also shows way, way back through 2010, 2011, when the real estate market was really dropping off again after the great financial crisis, and real estate markets continued falling until finally they had kind of come to their full bottom. Likelihood of real estate prices really dropping off dramatically, and even in that time frame in 2011, that was like a 5% drop off. It wasn't really a huge dramatic drop. It's not that likely. So if you're looking to buy a house, I wouldn't just sit on your hands for too long, even though rates are higher. What you can do is refinance them as they come down lower. But what's going to end up happening if rates really start dropping off, you're going to see real estate prices continually move higher, because what that's going to do is that's going to push more buyers out there to look to buy buy a home. And likelihood is they're going to be willing to bid up the price on it, which is a little bit of what happened over the last few years. So I wouldn't sit around too long if you're looking to do that. There's a lot of mortgage companies out there that are offering a lot of unique type of financing where they're, allowing you to get a mortgage through them and then later refinance it with no closing costs and different things like that. It's where they're trying to incentivize people to buy houses or at least, get mortgages. So don't sit around too long on that. Another chart that I thought kind of ties into that a little bit was I was looking at, this is just a population chart based on age going back through the census data of 2020. And in the green and the light green, you can see the Gen Zs there, or the post-millennial demographic born after 1996, the millennial demographic, which is 1981 to 1996, Gen X, baby boomers, the silent generation, and then the greatest generation, people born before 1928. So the biggest generation out there right now are those millennials by population, the Gen Xers and the whatever, or the Gen Zs and whoever's going to be after the Gen Zs, that demographic, while there's a lot of them, they're not buying houses. Those millennials, though, are the largest demographic, which they were baby boomer or Gen Xer kids, or the kids of those Gen Xers or baby boomers. So that's going to be one of the largest demographic pushes of people buying homes. And a lot of you out there that are watching this or know people that are in that millennial demographic that don't own homes, they are the prime, demographic to be buying homes, settling down, having family, getting married, having families, all that type of thing. So, that's going to be one of the big pushes from an economic standpoint that's going to push the housing market higher. One reason also as well, just tying into your guys' investments, is that I own a home construction fund within all of if you have an IRA with me, regardless of how aggressive or conservative you are, there's a home construction ETF or fund in there that owns, it's a fund that owns companies that build houses or develop houses like Pulte Group, Lennar, also like a Home Depot and a Lowe's that have their finger in the home construction world, because that's an area that over the next decade is going to do really, really well because there's such a shortage of housing out there. So those are the charts that I had for this past month. Again, great month for the stock market, your guys' portfolios. Great signs to see where the market's at and really kind of going into the end of the year. I'm optimistic that we're going to have a good December and roll into the new year with markets moving higher as well, just because of how well company earnings have been and just the relative price to earnings of those companies. So all good news there. For my clients in Pennsylvania, I will be doing in-person reviews here, so I'm likely to see a lot of you here over the next couple weeks. So look forward to seeing you all in person here over the next couple weeks for those people up in Pennsylvania. Because I'm doing in-person reviews, if you want to do an investment review via Zoom, we'll have to do it kind of second half of the month. We can schedule that. Just reach out to me, let me know. I'll be more than happy to do that. For any of you out there that have any friends, family members, coworkers, whoever that may be interested in having a conversation with me about their investments, get me their contact info or just give them my contact info, and we can connect that way. I greatly appreciate any introductions to people, but that's all I have for this month. Thanks everybody for taking the time to check me out. Until next time.